Hello, and welcome to the latest episode of the Friends of Sanctuary podcast. I'm Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. Today, I'm pleased to welcome our guest, Brian Levitt, Chief Global Market Strategist and Head of Strategy and Insights at Invesco. Brian, thank you so much for joining us.
It's my pleasure.
Today.
Thank you for including me.
As we're filming here in New York, there's a chill in the air. It's kind of cold here in New York.
I noticed.
And the markets have a chill.
Yes.
And I'm going to be excited to hear your views about what's happening in the markets. But you just kind of released, maybe towards the end of the year, your year ahead. And I'd like to start our conversation with the big macro and then dive down into markets, if that's okay with you.
Yeah, absolutely. Would love it.
So in terms of your macro picture for 2026, where are you with U.S. growth? Because we just printed a very strong GDP number. Looking at inflation, interest rates. So when you take a look from the big macro picture, how do you think the setup is for markets going into 2026?
The setup is quite good. I've struggled to find a bearish argument with regards to all of this. In essence, you've had a resilient U.S. economy that now looks like it's picking up some momentum amid expectations of interest rate cuts. We're still in a low rate environment. Oil prices are not particularly high. Credit spreads are tight. So all of that is conducive for this cycle to keep going. Not only that, for U.S. growth to actually improve over the year. So our view coming into this year was, a resilience and even a pickup in growth in the United States and opportunities for improving growth outside of the United States as well. Inflation's a big one, right? People always ask me, what's the risk to the outlook? What are you watching? And I would say I've been maniacally watching the Treasury break evens in a way that I don't typically, and that's just
measure inflation expectations.
Yeah, it's the nominal Treasury yield minus the TIPS yield gives you the bond market's expectation of inflation, and over 3 and 5 years, it's sitting below 2.5. Now, where I come from, that's price stability, and so in an environment of price stability with some relative weakness in the job market, Federal Reserve can lower interest rates, which of course tends to be good for markets.
So the labor market started showing some signs of weakness towards the end of last year, which gave the Fed room to cut interest rates. Recently, we've kind of got a mixed employment report where the unemployment rate, fell, but the job market is still showing some weakness, but maybe not as much weakness as was expected. Where are you seeing the labor market?
Businesses are somewhat cautious to hire more for a variety of different reasons. One is they keep running into all of these different events, political or geopolitical, that cause concern. There's also still businesses trying to better understand what artificial intelligence will mean and the size of the workforce that they will require. Now, interestingly enough, as the demand for labor has slowed, the supply of labor has also diminished as Americans retire or as less Americans come into the country, legally immigrating into the country. So you end up with both less demand and less supply, an unemployment rate that does not go up meaningfully, and jobless claims that don't go up meaningfully. It's not businesses that are slashing workers, but the rate of hiring has slowed, and that gives the Fed some cover to lower rates from a level that I would still consider to be somewhat prohibitive given where labor market growth is.
Do you think we will get additional rate cuts this year?
I do, and I've generally been of the view that if you think of a 10-year rate that's sitting around 4.25, a reasonably appropriate steep yield curve would be short rates at around 3%, and that would give us a few rate cuts this year. The market is priced for it, although it bounces around depending on who's going to be the Fed chair or what tariffs are going to look like. But the market has been priced for it. And in an environment where inflation expectations are contained, I don't see any reason why you wouldn't want to work towards a steeper yield curve and prolong what I think is a cycle that can keep going.
So we're in a midterm election year. The markets historically have a lot of volatility. And as we entered 2026, the geopolitical backdrop started to escalate. On January 3rd, the United States went in and removed Maduro from Venezuela. Tensions are rising with Greenland. There's threats of higher tariffs on NATO countries. That's a lot of geopolitical events to digest in less than a month for investors. So when you're talking to investors, I'm sure they're concerned about the geopolitical backdrop. What's the advice you're giving to them when it comes to their portfolios?
I always ask investors to answer two questions when a geopolitical event happens. Does it change the trajectory of the U.S. economy? And does it change what the U.S. Federal Reserve is going to do? And if the answer to those questions are no, then you can generally ignore them from the perspective of your portfolio. So let's take each of these one at a time. Venezuela, I would argue no and no, right? Venezuela is a small economy, has not had a meaningful impact on oil prices. So no. Iran, similar story. Fed independence is a little bit different, although I do think the construct of the Fed will remain. With regards to midterm elections, you'll probably get a divided government, so that doesn't meaningfully change the trajectory.
Generally, that's a positive
for markets. The markets seem to be I don't know how statistically significant that is because we don't have thousands of years of data, but nonetheless, yes. Historically, the markets have done better with a divided government. Now, with regards to Greenland and the tariffs, I would just advise investors not to panic. I would think about it from the perspective of what transpired during Liberation Day when the Trump administration first put out the reciprocal tariff rates. The market was significantly volatile. You did gap down. You saw rates come up. But when there were yips in the bond market, the administration changed their approach, 90-day pauses, and April 9th became the third best day in S&P 500 history over the last 30 years.
Yeah, the markets came
roaring back. So that's the risk you have when you're trying to invest based on headlines, is that you're going to be whipsawed. And this is clearly an administration that has proven that they like to put things out there to draw attention, to perhaps pressure related parties into acting, but have a willingness to back off of their the worst of what the market fears.
Yeah, when we put out our year ahead, we titled it to be fearless because we were expecting volatility. Maybe not all this geopolitical volatility, but I think investors need to be fearless and be patient and not make emotional decisions in their portfolio.
I think that's always great advice. I mean, you talk about those best days in the market. What tends to happen is by the time investors get out, they've captured the worst days in the market, and the worst days in the market are almost always grouped with the best days. The third and fourth best days of the last 30 years, number 3 is, like I mentioned, April 9th after Liberation Day. Number 4 is March 23rd, 2020 during COVID. So, you try and time these things. It really does long-term damage to the portfolio. I think be fearless is a great message to investors.
Thank you. We're not finished with all the geopolitical.
That wasn't it?
No, that wasn't it.
There's more to go on this?
Well, we got to dive a little bit more into the Fed.
Okay.
Right?
Yeah.
So the Justice Department is pursuing criminal charges against Chair Powell. In my career, and I've been doing this for 40 years, I've never seen anything like this. And what I find ironic is normally, his term is probably, by the time this airs, is less than 100 days. Normally when their term is up, meaning the chair, they normally leave and go out into the private market. Now, Powell does have the option of staying on the board for 2 more years if he wants to. Mm-hmm. It's hard to understand why all of this is happening with the Fed. How are you explaining this to clients?
It's pretty clear that the administration wants lower interest rates, and they want lower interest rates in order to get activity going again in the housing market and the construction market. The challenge with all of this is the Fed controls short rates. You lower short-term interest rates too much, long rates are going to go up. So I think the administration knows that. I hope that cooler heads prevail with regards to it. Now, we're in a decent spot. As I mentioned, the market is already primed for 3 rate cuts this year, so 3%. And so if a new Fed chair were to come in, whether it's Kevin Warsh, whether it's Kevin Hassett, whoever it is, three rate cuts are already priced. And so that gives the new Fed chair some room. Now, what's interesting with regards to Powell is investors have to realize that you don't elect an autocrat to run the Fed. Powell stays. You still have the Fed governors who are largely independent from the political arena. You still have, assuming Lisa Cook stays, a number of Biden appointees. Plus, of the Trump appointees, Chris Waller and Michelle Bowman have generally been voting in line with the Fed chair. So I don't think we're losing Fed independence. What would it look like if we were losing Fed independence? 3 and 5 year inflation break-evens would be moving a lot higher. That's a bear case to the outlook. So I don't want to do too much inside baseball here, but if investors want to know what it would take for Brian Levitt to become bearish, inflation expectations rising and corporate borrowing costs going up along with it.
So getting a little bit more deeper in what's happening with the Fed, President Trump recently had comments that the market interpreted that the new chair will not be Kevin Hassett. And that raised the odds for Walsh.
The other Kevin.
Yeah, the other Kevin. And the bond market did not like that.
Yeah,
the longer end actually ticked up. He tends to be a little bit more hawkish. Any insight into that? Do you think it's just noise and we just have to wait and hear who the president speaks to, or is there something to the rate backing up on the 10-year?
I think this will change a number of times over the next days. I mean, Trump definitely likes the cliffhangers and definitely likes us staying involved and watching and discussing these things. So I would view this as part of that. Interestingly, Kevin Warsh was more hawkish following the global financial crisis, an environment in which he felt policy was simply too accommodative and wanted to go back to a more normalized environment. In hindsight, I would look back at that period. Even at the time, I was saying it, we needed policy accommodations. There was not much inflation to speak of, not much growth to speak of, and we needed to do everything we could do to support it. So will Kevin Warsh, if he's Fed chair, be more hawkish in this environment as he was after the financial crisis? We'll see. I would argue policy is still somewhat restrictive given the environment that we're in, and there is room to lower rates. So we'll see how he will behave. Again, he's not alone, right? He will try and produce a unified Fed, but there are the governors, there are the Biden appointees who will also have a say in what policy looks like. Ultimately, I think short rates are heading to 3%, regardless of who the next Fed chair is. But, is there risks around that outlook? Sure.
Just so you know, I agree with you. A little volatility around rates, but they're actually look like they're going to decline. So let's dive into investments. In your 2026 outlook, where are you telling investors to invest in terms of the equity market? What do you like?
Yeah, we were talking about rebalancing, and we still are. So rebalancing from what? A lot of investors had gotten very heavily concentrated in the AI trade, and their portfolios were sitting at pretty excessive valuations for their own liking. Valuations are not timing tools, but for their own liking. And so if those are the two risks, you want to think about how can I build a less concentrated portfolio and how can I lower the overall valuation of my portfolio. Now that comes with a caveat, because just because something is cheap doesn't mean that it's not going to stay cheap. So is there a catalyst for other parts of the market besides mega cap growth to perform well? And we believe there is. Now, what are those catalysts? Lower central bank rates, policy accommodations in other parts of the world, improving economic activity in the United States. Those types of things help to unlock value. And where are some of the deepest value markets? Those are outside of the United States. And so if the Fed is lowering rates, typically that's a benign or weaker dollar environment. So we were talking about moving down in capitalization to mid caps, which are at better valuations and tend to perform well in an improving growth environment. Small caps do well in a lower rate environment, and non-US assets perform well in a weaker dollar environment. all of that, if you can allocate to those parts of the market, gives you a significantly lower valuation than what you have in the broad S&P 500. Now, there'll be fits and starts. If you have days where geopolitical concerns and rates are going up, and you'll have fits and starts there. But if the broad case of our view plays out, which is lower short rates from the Fed, improving growth in the US and China and the emerging economies, then that should support a broader market, and quite frankly already has over the last 3 months.
That's what I was going to point out, at least as we're taping this. You got a breakout to all-time new highs finally from the transports. We haven't seen a new high from transports since November of 21. We are seeing small cap, mid cap, and non-US outperform the US, continue, at least the non-US continue their outperformance, but now getting that small cap, mid cap. So you're in a camp that that's going to continue.
That's going to continue. We'll see to the extent that it, we'll review at the mid-year, but this is certainly a theme for this year. Now, why do we review? You want to make sure that policy is following through. You want to make sure that growth is improving. So we'll be watching those leading indicators in the US, China, and other emerging markets very closely. If you look at a leading indicator of the US, you look at the traditional economy, take, for example, the ISM Manufacturing Purchasing Managers Index, it's not really doing much of anything, right? And so what you want to start to see is some pickup in the traditional parts of the US economy, which will start to broaden out market performance even further. We think we'll get there, but we'll be assessing it as the year goes on.
So last year, I felt like every time I turned on a Wall Street news channel, the question was, are we in an AI bubble? Mm-hmm. Are we in an AI bubble? So you're talking about rebalancing, which especially when the AI trade is about 40% or was 40% of the S&P, makes a lot of sense. But are you in the camp that there was an AI bubble? Doesn't sound like you think there was an AI bubble.
I'm not in the AI bubble camp. I started in this industry in 1998. I know what a bubble looks like, and I remember coming in every day in 98 and 99 thinking this was the greatest job ever. Everything's up 5% every day, and that has certainly not been the case. If you look at the NASDAQ 100 from 1995 through 1999, it was up about 1,000%. If you look at the NASDAQ 100 since ChatGPT came out in 2022, it's up about 200%. So this is significantly different, and I'm certainly not the first person to mention that a lot of the businesses that are driving the activity in it are very well funded, have net cash to EBITDA of negative or moving slightly positive.
They're real companies.
Real companies. Now, are there some names that may be over their skis with this? Are there some businesses that may be promising investment or promising purchases in the future that they may not be able to deliver if the revenues don't arrive at exactly the right time? Yes. But in terms of the broad S&P 500 and the big mega cap names, they are not exposed anywhere near the extent that some of the dot-com names or the names connected to the dot-com businesses were in the late 90s.
And the valuations are totally different.
Valuations are totally different. I mean, you compare an NVIDIA to a Cisco. NVIDIA today at 20-something times earnings to a Cisco is probably trading at 80 times earnings in the 1990s. Very, very different story.
And some of the valuations have actually come down.
That's what happens.
Right? As the earnings have improved,
yeah.
Right?
You grow into your earnings. I mean, that's why you pay up for growth stocks, on the expectation that they will grow into their earnings. And if you're going to be in a slow growth global environment like we were in from 23 to 24, you're supposed to bid up for growth names. What you and I are discussing here.
What's scarce? They had the earnings, and there was scarcity of earnings, so investors were willing to pay up for it.
Pay up for it, and if you can get into an environment where rates are less prohibitive, the economy's picking up, then you don't have to pay as much for growth businesses, because there's going to be opportunities in more cyclical, value-oriented, smaller capitalization businesses as well as non-U.S. companies.
One of the things that I feel is different, that you don't traditionally see in every market, is how precious metals are performing. Gold and silver and the metal stocks. And we even have the industrial metals like copper near record all-time highs. Do you think it's too late to invest in the metal space, or do you think there's something still there?
I would be optimistic about the industrial metal space over time. Now, silver's had quite a move, but the industrial metal space, I think, is a long-term theme, given the build-out that's going to be required along this new technological wave. Now,
like data centers,
exactly,
energy.
exactly. It doesn't mean there won't be moments of consolidation in those names, but long-term bullish. A more interesting question is probably around gold. Now, what's been driving gold really since Russia went into Ukraine and had U.S. dollar assets frozen? There's been diversification by central banks into gold. And then you've seen the retail investor follow, and I think gold's up like 75% over the last year. So when you have these types of moves, you want to be mindful against hurting or piling in. You don't want to be the last one into that trade. What's driving it right now is geopolitical risks. That could be tempered at a moment's notice. So the way I think about gold is it's never this is my rah-rah total return opportunity. This is more of a hedge in my portfolio against potential weakness in the dollar and against concerns about U.S. politics.
What about the metal stocks themselves? Do you have any views there?
Yeah, I would just be mindful of anything that's had too big of a move. And
think longer term, dollar cost averaging if you're interested.
But don't. I just be mindful to herd into parts of the market that have had such significant moves.
Let's talk about areas that are classified as value.
Mm-hmm.
Financials,
Mm-hmm.
energy,
Mm-hmm.
big, especially financials in small cap.
Yes.
Are you finding any value in the financials?
Yeah, there's still value in the financials. I mean, they had quite a move in 2025, but that was coming on
particularly
the heels,
the banks,
the
right?
banks, but coming on the heels of a prolonged period of underperformance. So, what are the themes that are driving the financial sector? It's steepening of the yield curve, right? So we need to continue to see that happen. It's really what's happening in the capital markets, in the IPO space, mergers and acquisitions, some signs of deregulation. In the asset management space, demand for products and solutions. So the financials backdrop is a sound one, again, so long as the base case on our view on growth continues to play out.
What about energy, right? We've seen fits and starts in energy. With concerns about the U.S. going into Iran, we got a breakout in oil, and then it pulled it back, but you saw the energy stocks move. Any opportunities in the energy space?
Yeah, the energy space has been underloved, which is a good thing from a consumer perspective. Energy tends to be a bit more late cycle. By the time prices rise, that's when the consumer starts to roll over. So I guess we have to be a little bit careful what we wish for. The good news is this is not the late 1970s. The U.S. is sitting on a significant capability to produce oil. You bring Venezuela slowly back online. It's going to take time, but you could actually increase oil supply to the world. I'd say the one risk in that would be Iran. Iran, of course, produces a significant amount of oil and has a significant amount of reserves. If that dynamic were to change, then perhaps you could see oil prices heading higher. But I would say right now we're in a pretty good place from oil perspective with regards to supply and demand. And if I were thinking energy prices were to blow out, that's late cycle, and that's not where I am.
You mentioned the consumer. Let's talk about the consumer. We hear about this K economy.
Yeah.
Maybe you can explain, because some people don't know what a K economy is. And where do you see the consumer in 2026?
Yeah, so a K economy, consider it household total net worth. So if you're at the upper end, the stock market has done quite well. The bond market rallied last year. Your home has done quite well. And so you're feeling good with all-time high net worth in aggregate. Now, for the other side of the K, or the part of the K that goes down, you're dealing with higher prices. You're dealing with slower job growth, a decline in the number of job openings, and so you're not feeling as good. And the way I've explained this to people, and I hope it doesn't sound flippant, but what ends up happening in a country like ours, if the lowest income quintile or the two lower income quintiles come under pressure, it's a slowdown in economic activity, and policy easing can help on the margin. It's not a panacea, but it can help. It's really when the upper income quintile or quintiles fall under pressure that you start to think more of a recession. And so the slowdown at the lower end of the K is what's driving a lot of impetus for easier policy and for things like the One Big Beautiful Bill Act. It's the administration looking to provide some support to the lower income quintiles ahead of the midterm election. And so I would say in aggregate, there's enough support, fiscal and likely monetary, to continue to support the consumer. Now, if you look at consumer sentiment, and these are generally done by my alma mater, the University of Michigan, they look quite dire. People are not feeling good, and a lot of that has to do with prices. Notice I didn't say the inflation rate, I said prices, right? Because
the inflation rate has come down,
yeah,
but prices are still elevated.
Yeah,
so when you go grocery shopping, your bill's not coming down.
Right. I mean, if the inflation rate goes from 3 to 2.5% year over year, you're still 2.5% higher than you were a year ago. I mean, the Fed wants price stability, right? So those are two different arguments. So the consumer's not feeling great, but continues to consume. And actually, if you look at credit card delinquencies, there was a whole bunch of conversation about credit card delinquencies in 23 or 24. I used to joke that was just the Taylor Swift Eras tour, but in actuality, it was inflation. And as soon as inflation flatlined at 3%, right? I'm not saying inflation disappeared. As soon as the rate of change flatlined, so too did credit card delinquency. So the consumer's in better place than I think the news media wanted us to believe a year or two ago.
You talked about non-U.S. equities as being an opportunity, good value. What pockets in the developed and emerging markets do you like?
Really like the emerging markets. And if you look historically at periods, when we went back over 50 years, at periods when the Fed is easing, it tends to be dollar weakness. And then if you look around the world for what parts of the market do best in a period of dollar weakness, Europe does fine. Japan does fine, but it's typically the emerging markets who are among the outperformers. And why is that? Because it gives the emerging markets cover to lower interest rates and support growth. And, when you think of the emerging markets, it's not only, our parents' emerging markets. Remember, last year started with DeepSeek. Right, so it's a lot about innovation. Yeah, a lot of innovation in China, Korea, Taiwan. Whether we can quibble about whether those are emerging economies, but certainly non-U.S. places to invest were, those were really deep value markets, and I would categorize them as value markets now.
And then Vietnam, I believe, was recently added to the emerging market index, and you're seeing a lot of things move into that area as companies are moving away from China.
Correct.
From having concentrated exposure.
Correct. And then that's all part of the, changing where the global supply chains are or reshoring. Places like Vietnam, places like Mexico certainly benefit from that given their productive capabilities and their proximities to major markets.
So if you were going to invest in the non-U.S. or international developed markets, are there any particular favorites that you have?
Yeah, I think you have to look at Europe as another place where valuations are attractive. The ECB has already lowered interest rates significantly, and you've got this fiscal spend coming, and news out of Greenland, news out of Davos. All it does is suggest to me more Europe, not less. And for so many years, the challenge of Europe is Europe breaking? Does Europe have the impetus to do what is required for the continent? And I think it's increasingly a Europe that is recognizing that it needs to stand more on its own, for better or for worse, and that means greater fiscal spend. That means higher infrastructure investment. All of that should be conducive for better growth there.
And you saw the commitment of Germany last year,
which was a huge sea change,
right?
Yeah.
$500 billion
huge sea
in
change.
defense over 10-year time frame, and I think investors might be underestimating the power of that.
I do too, and when we talk about U.S. exceptionalism, you and I are sitting here in New York City, and we like to think we're exceptional. A lot of U.S. exceptionalism was the U.S.'s willingness to respond with force to crisis, whether that was in 2008 or in 2020. recovered faster than the rest of the world, and we had some great tech businesses. And a lot of U.S. exceptionalism was driven by that. Part of that now, you look at China, really interesting tech businesses. You look at Europe, a willingness to respond to what they view as a crisis. That's a big sea change from ECB Chair Trichet raising interest rates in 2011, right, inexplicably. So this is, or forcing austerity on the Greeks. This is a very, very different backdrop for Europe.
So let's go to fixed income. So you see interest rates coming down. That's generally a good backdrop for a fixed income portfolio. For investors that are looking to invest in fixed income, are there particular pockets that you favor over others?
Yeah, I view short rates coming down, right? So we talked about the Fed lowering rates to 3%. Now, a lot of people are sitting in money markets, right? So you see, substantial sum, was it $7.5 trillion in money markets?
More, I think now it's 7.7.
Yeah, I mean, look, that was a lot of that is people paying attention, right? I mean, if you're in a regional bank, or I shouldn't say regional, if you're in one of the money center banks getting zero on your deposits, you should go to money markets. I wonder how much of that goes back to bank deposits, or how much of that is people getting used to a nice yield on this. And so you do have reinvestment risk there as the Fed lowers interest rates. And so what do? You need to step out. Do you want to take on duration risk or interest rate sensitivity? I look at a 10-year yielding 4.25, 4.3. That seems pretty fair value if you consider a yield curve is typically 125 or 1.25% steep, right? So the 10-year seems reasonably priced. Move out into, unis where tax equivalent yields are attractive and the economy seems okay. 5% in corporate bonds or 7-8% in high yield bonds. That all seems quite attractive so long as the economy doesn't roll over. And you look in the traditional corporate bond indices now, whether that's investment grade or whether that's high yield, fundamentals look quite sound. It's not an over-levered economy. It's not businesses that, have a huge wall of payments coming with regards to maturities and rates that have gone up substantially on them. And so, there's significant opportunity, or even move out into private credit where the liquidity premium gets you an even greater yield than that. So it's all part of the same trade once you move beyond treasuries. Is the economy sound? And can I harness income in that environment? The last one I'll mention is non-US bonds, right? If you want to generate income in a currency that's not the US dollar during a period of weaker dollar, then a very attractive place to do that is in non-US bonds, particularly emerging markets, as we've talked about.
One pocket you didn't talk about was mortgages. The administration is encouraging, I think, Fannie and Freddie to buy back mortgages, about $200 billion. Is there anything in the mortgage market? Can you get an extra maybe pickup in yield in mortgage?
Yeah, the market will start to price in a lot of that fairly quickly, this effort to drive down mortgages. But look, if you figure, a 3 funds rate, 1.25 over that for the Treasury, another 175 or so on, to get to your 30-year mortgage, that's a 6% mortgage rate. You and I remember a world 6 years ago when people were begging for 4% on anything. And you had to lend money to the Russian government back then to get 4% or high yield. So yeah, anything beyond treasuries here, so long as you think households are holding up and businesses are in good shape, which we believe they are, and we believe policy is supportive, then yeah, we should look to harness yields in those parts of the market.
The other pocket you talked about was private credit. There were kind of some, I'll politely say, some hiccups in the private credit market, some concerns about defaults. Not all of them were necessarily credit related. Are there any concerns that you have in the private markets?
Cockroaches, right?
Yep, that was Jamie Dimon talked about cockroaches.
Cockroaches versus termites, I think, right?
Yeah.
I mean, you see a cockroach, you may see another cockroach, but the structural foundation of your home isn't coming down. You see termites, that's when it's a bigger challenge. And I don't think we're seeing termites here. It's important to remember that one of the bigger high-profile stories in the private credit market was a fraud and the other one,
And not a credit issue.
yeah, and the other one was related to, I believe, subprime auto loans, largely to an immigrant community or communities, which of course the demographics of the country shifted on that. So those, we all had to answer that day whether they were systemic, and our view, particularly within our private credit team, is no, these are not systemic. In fact, you talk to the private credit managers, they're still very excited about the deal flow that finds its way to them that had previously been within the traditional banking system, right? So given the regulatory environment on banks, more deals come into the private space. You want to make sure you know who you're investing with. You want to make sure you understand the quality of deals that are getting done within the portfolio. But in the aggregate, we're not looking at an environment where the credit markets in the U.S. appear ready to deteriorate significantly.
Another area we agree on.
Maybe that's a concern.
I don't know. Maybe we're
much.
a little too consensus here.
Exactly.
Crypto market, because Invesco has exposure to the crypto market. Any views on Bitcoin, Ethereum? Is this a real investable asset class? Are you recommending for clients that could add volatility to add any crypto exposure?
I'm certainly not the world's foremost expert on crypto, and I remind investors that they do have to recognize the volatility embedded in this, and they do need to think hard about what's potentially backing it in the event that there's some type of crisis in the world. That said, remarkably, these digital assets have become something like 3 to 5% of global market cap. And if you want to invest alongside global market capitalization, I think 3 to 5% is your starting point now, underweight, overweight, based on your own risk tolerance and the type of volatility that you would be willing to deal with in a portfolio. We know these things are highly volatile. Now, Bitcoin, if you talk to the technical analysts, it held at support, right? And every time it's held at support, it's done nice things in the year or two after. So take that for what it's worth. I think Bitcoin in general could be viewed as a hedge against dollar weakness here. Things like Ethereum will be more based on usage in the future and industrial purpose. And to me, that does seem something that's going to be a longer term structural theme.
I'm curious, in your data set that you look at, are you seeing clients actually start to add exposure to crypto, or is it still a very small percentage?
We are seeing it, and I think there's a bit of the FOMO trade, right? I don't want to miss out on this, at least have some. Right, whether that's not 3 to 5%, but at least have some. We are starting to see that.
Are you seeing it generational, meaning
yes,
that some of the younger people are more willing to take that volatility risk and they have that longer term investment horizon versus maybe, let's say, the baby boomers?
Yeah, I think so. I think that's right. And what you also have to recognize is that it's still pretty concentrated who owns this, right? So it's starting to broaden out as the exchange traded funds have provided access to it. But I don't remember the exact number, but it's still very heavily concentrated in terms of who owns Bitcoin globally.
We're coming towards the end of the interview.
Well, that's disappointing.
This has flown by. We've talked about a lot of subjects. Mm-hmm. Is there anything I didn't ask you that you think investors should know?
Yeah, I think investors should take a step back and think about how cycles play out. They're going to be bombarded with the news flow. The news flow if you let your emotions get the best of you, to your point around being fearless, you tend to make bad mistakes at inopportune times. So obviously you want to be on top of news flow, but you don't want to have it drive your portfolio. Think about, are we early, middle, or late cycle? We're definitely not early. That's when we got out of our homes from COVID. Mid-cycle, that's when valuations get a bit extended, credit spreads get tight. You can be there for a while. You want to understand, what does the end of a cycle look like? And it's usually an over-levered economy, too much excess in the economy, the Fed raising rates, corporate borrowing costs going up, the bankers tightening lending standards. None of that's happening right now.
And we have the big, beautiful bill that's going to kick in.
Yeah. People always ask me what I'm scared of. So those are the things I'm scared of. and I don't see any of them flashing red right now.
That's awesome and a great message. Brian, this has just been a great conversation. We've covered so many different topics. We really appreciate your expert advice as, volatility is really picked up here in 2026.
It has been absolutely my pleasure. Thank you so much for including me on the show.
And I want to thank all of you for tuning in as well.
Thank you for watching or listening to the Friends of Sanctuary podcast. Tune in next month to be sure not to miss out on the next installment of the series.
Securities offered through Sanctuary Securities, Inc., member FINRA SIPC. Advisory services offered through the SEC Registered Investment Advisors, Sanctuary Advisors LLC, and True Independence. Sanctuary Wealth consists of the wholly owned subsidiaries, Sanctuary Advisors LLC, Sanctuary Securities, Inc., and True Independence, as well as Sanctuary Alternative Holdings, Sanctuary Asset Management, Sanctuary Insurance Solutions, Sanctuary Global, and Sanctuary Global Family Office.